We had some good payments this month, however I was a bit disappointed as we walked away from this month with 8.25% less income than what we did in July of 2022. This came down to a couple of reasons I will explain later in the video, but without further ado, let's get into who paid what for the month of July. So the first payment on the list was from ACP. This was the final payment from the stock after I sold the totality of my position last month and then used that money to buy more of AGNC, who offers similar services as far as mortgage REITs go. ACP's health was consistently looking worse and worse as the months went by, and in my opinion it was not a safe option for the years to come. Therefore, as AGNC is essentially a direct competitor of ACP, I thought it better to purchase more of a company I believe has more to offer in the future. Speaking of AGNC, they managed to pay out yet another monthly dividend of $3.17, bringing the total paid for the year to $14.39. Although me buying it last month and then not stating outright that it is a recommended buy is a contradictory statement, the reason behind my viewpoint is because it's the better of the two evils as far as MREITs go. Although current management has stated that they can continue to support the current dividend, I am slightly dubious, as if we look at their price and dividend trend over the long term, you can see that when price lowers, the dividend is not far behind in following a reduction as well. And ever since mid-2021, the price has been reducing. I still have a relatively small position in AGNC, so I'm not too worried that it is trading at $10.18, which is above its book value per share of $9.41, which represents an unfair value differential for the investor of 8.2%. However, in saying that, I believe owning some agency will eventually pay off. This is due to the fact that eventually there will be a yield curve inversion, and agency will benefit on higher yields on mortgage-backed securities it owns. This is because agency and companies like agency aim to borrow money at short-term rates and then use the capital to buy higher-yielding long-term assets, such as mortgage-backed securities. Currently, the yield curve on these bonds is inverted, with short-term assets yielding higher than long-term assets, which has meant that the borrowing costs of agency have essentially cut into its profit margin massively. No one really knows how long it will take for the curve to invert again, but as I have such a small position, I don't mind swinging for the fences on this one and then using this as a bit of an experiment to test my theory. Another promising trait of agency is that they exclusively buy mortgage-backed securities, which are backed by the federal government, so in the event of a default, they can recoup their losses, which provides a bit of added protection for investors. I will say that if you want a better monthly payer as far as dividends go, that is also a real estate investment trust, then look at Realty Income, whose dividend per share percentage change has dramatically increased compared to agency since 2014. Their business slightly differs in the sense that they don't buy MBSs. Instead, they purchase physical stock, such as commercial and residential properties, and then act as a landlord. It is a simple and somewhat boring business model, but it does scream reliability. Just take a look at their dividends, which has increased 4.4% annually over the past 30 years, which slightly outpaces inflation. For those looking for a modest yield, solid returns, then look no further. I know I've been looking at adding this holding to my portfolio for a while now. BST then paid out a dividend of $2.15, which brings the total to $12.59. The stock itself has performed solidly since the start of the year by providing capital gains of 23.16%. Their dividend has remained the same for the entirety of 2023 up to Q2, and I have a sneaky suspicion that it will grow as both their net income and diluted earnings per share when compared to Q2 of 2022 has grown by 27% and 28% respectively. BlackRock's equity funds, which BST is a small part of, holds 52% of the assets under management. This also increased from 2002's Q2 by 2%, which also hints at a potential DPS increase due to their assets under management increases being likely to increase profit also. The tech space itself has performed strong during the first half of 2023 and it looks to continue to do so, which bodes extremely well for BST. EFC then paid out $5.49, which brings the total paid to $32.20 for the year thus far. They're still yet to release their Q2 earnings, however the stock has been on the rise since the start of the year. And with the higher than average interest rates, mortgage REITs have been able to profit reasonably well. They have decreased their long-term positions for the same reason that AGNC has, due to an inverted yield curve on the short-term versus long-term rates on money lent. It's nice to see that all the loans EFC offers are first line, as it gives greater security of loans, not resulting in default, as defaults could result in seizing a property from the borrower who has failed to pay. It's also nice to see that their loans are floating, so payments on a loan always represent the fair market rate. Although their free cash flow has remained negative over the past 9 months, their earnings per share has been able to grow, and I believe once we see their Q2 performance, their free cash flow position will increase as to their EPS. EPS. Another final point to note is the ownership breakdown of the EFC. Although institutions can get it wrong at times and can affect the stock performance greatly if they decide to sell a large portion of their position, it is somewhat reinforcing to see that the hedge fund managers see a potential upside to the stock at this present point in time. Eaton Vance paid out $2.87, which brings the total paid to $60.43. It's nice to see that over the short-term position, their net asset value is higher than the S&P 500, which I believe is due to there being less outstanding shares for ETY, which will hence increase the NAV percentage and potential perceived value of the fund due to simple supply and demand theory. The fund has a high exposure to tech and therefore in future AI projects, depending on a company's future direction. I'm hopeful that this will work well to boost the profits of the fund in the near future with the boom AI will most likely see. All of their major tech holdings, such as Intuit, Microsoft, Palo Alto Networks, Salesforce, Accenture PLC, Alphabet, and Meta platforms, have some form of expressed interest of being completely or partially AI-driven, which is great as in terms of exposure to industry and profits for ETY in the future. FSK paid out the remainder of its dividend for this month at 70 US cents per share, which netted us 18 New Zealand dollars and 76 cents. The company is still struggling since last month, and I may look at slightly altering my position here due to its payment in kind percentage being well over the recommended amount. As I've said before, if you're looking for a solid BDC, then check out Mainstreet Capital or Pennant Park. Both are more reliable and have a more consistent history of dividend increases when compared to FSK. Our other BDC, Horizon, paid out $9.55, which represents a slight increase to last month due to reinvesting the dividend. Total paid out by Horizon now sits at 62 New Zealand dollars and 53 cents. They've already announced that their monthly dividend per share for the rest of the year will stay at 11 US cents per share, which is great to see as I assume they've made this move to convince shareholders that even with their deteriorating credit quality and high debt investment risks growing from 5.1% to 13.6% of its portfolio, they're still able to generate profit to pay the dividend. What's really benefiting Horizon as well as other BDCs is that most of their loans are at a variable rate. The high interest rates have increased their yield on their debt instruments. This is a bit of a catch-20 though, as with this increase it's more likely to see an increase in defaults as well. I think the stock is worth holding onto for the future, regardless of major institutions such as Citadel and Millennium Management now exiting. Positives for the company consist of their portfolio growing by 24% year over year to $714 million. They've also reduced their lower credit rating investments and increased their investments in companies with a better credit rating when compared to 2022. So it shows that their management has a responsible take on trying to reduce risk when heading into uncertain times, which is promising to see. The only major bad aspect from their Q2 results that rings slight alarm bells for me was reading that they experienced 6 liquidity events from companies within their portfolio. It seems that all companies have been able to, in full satisfaction, meet their obligations to Horizon and repay the loan, apart from Avalo Therapeutics, who only managed a partial paydown of $4.7 million US. Next, we had a payment from the India Fund, who paid another of its almost sporadic dividends, which came to 31 New Zealand dollars and 59 cents. The fund is now our biggest payers of the year, so far after earning the portfolio 181 New Zealand dollars and 16 cents in dividends. During July, it was trading at a 0.64 discount, which is great for investors looking to buy into the fund. The fund itself invests in a wide range of sectors, and it's great to see that its top 10 holdings, which make up 50% of the fund's investments, are reasonably diverse and invests in areas such as telecommunications, consumer staples, financials, both mortgage REITs and banks, utilities and industrial areas, which makes it reasonably diverse and strong in terms of performance in most market situations. Their second quarter report has still not been released, so it's hard to see what exactly their performance has been to date. However, I'm confident that due to the market starting to recover, their revenue will be at less of a loss than what it was in 2022. If anything, it's probably a great time to buy more of the stock due to its slumped 2022 price, looking to now recover as we head into the second half of 2023. This isn't a priority stock of mine, but it's thought by analysts such as Deloitte that India's GDP will continue to grow by 6 to 7% per year, which can only make good things for the fund's profitability. Just keep in mind when buying into the fund of their 1.9% management fee. After having to sell out of JPG due to a forced sale with the fund closing, I decided to reinvest into Jippy. Jippy has been on my radar for a few years now, and it seems like it's a well-performing fund for generating capital gains and income. I'm somewhat doubling up with this fund, as my largest portfolio holding is VOO, and Jippy's largest holding is also the S&P 500, which it uses to benchmark its performance. Jiffy for this month managed to pay us out $3 New Zealand and 12 cents for a holding of 3.5 shares. The nice thing with this fund is that they look to offer monthly income with less volatility than the S&P 500. If we look at the fund side by side from the inception date of Jiffy, we can see that this is the case, as with lower volatility usually comes lower returns. VO has been able to outpace the fund by close to 15% if dividends were reinvested. So if you want more growth over the dividends, then VO is still the better option. I think that since the fund is only 3 years old, it still has some dust that needs to blow out of the cogs before we see stronger performances. The only issue is that dividends are all over the place, so it's not good for those who need dependable monthly income. We may see these dividends become more reliable after the fund builds up its cash reserves. Mainfreight then provided us with the first of its semi-annual dividend payment of $13 New Zealand and 99 cents. This stock is one which I aim to increase my position in greatly due to its continued year-over-year solid performance as a global logistics company. Most notably, their return on equity for the past trailing 12 months sits at an impressive 25%, which is one of the higher ROEs I've seen. This means for every $1 of shareholder equity, the company was able to generate 25% in profit. By looking at the past 3 years, Mainfreight has averaged a payout ratio of close to 40%, which means that it's retaining 60% of its profits. This suggests that their dividend is well covered and that they've been using the 60% efficiently to continue their high growth trend. Over the last 5 years, Mainfreight has actually managed to return 232% to its shareholders. I truly believe Mainfreight has the ability to continue this trend and get to the value of $100 New Zealand per share. Naturally, with the increased profits and share price, their dividend shall too increase. It is still slightly overvalued at this current point in time, but for good reason, so just keep that in mind if you plan on increasing your position in the stock. Newtek paid out its third dividend of the year with now only one repayment remaining for 2023. The third dividend came in at $15 New Zealand and 73 cents, which brings the yearly total paid by Newtek to $83 New Zealand and 20 cents. Their dividend has dropped immensely from the first payment in January of 70 US cents per share, which netted us 53 New Zealand and 18 cents. It's now dropped down to 18 US cents per share. This is due to their profits dropping from 37% down to 28% across the first half of 2023. Quarter 2 earnings show that the company had a net income of 6.9 million or 26 US cents per share for the quarter 2 alone, and 18.6 million or 72 cents per share for 2023 thus far, which indicates that earnings have slowed down during the second portion of the year. On a positive though, their assets under management has also grown from 1.2 billion in March 2023 to 1.4 billion in June 2023, according to their reports. The jury's out on whether or not the rest of the year will see a positive change in Newt's performance, as with high interest rates, you'd usually expect to see a BDC's ability to achieve more due to usually having the majority of their assets at floating rates. I'm hopeful that performance will increase, especially as expected by the Feds. The final interest rate hike might have already happened in July. If that is the case, then management at Newt should hopefully be able to lock in part of their remaining assets they don't have at floating rates into fixed rate terms. Prospect Capital paid out $80 New Zealand and 35 cents, which brings the yearly total to $122 New Zealand and 12 cents. I decided to reinvest half that money back into TSLX this month and will probably continue to do so in the future. This is due to the promising performance they have had in the past few months and my only income available at this time to invest into other shares being from dividends instead of cash. As I've said in last month's video, Prospect Capital's performance as of late hasn't been the best, and it's definitely one of the riskier BDCs to invest in. I'll suggest for those looking to invest in a BDC to invest elsewhere purely due to the downwards trend of their dividend and their high payment in kind percentage at this current point in time. STAG Industrial then paid out $3 New Zealand and 71 cents, which brings the yearly total to $25 New Zealand and 44 cents. Not much has changed for the month of July. As I said last month, their quarter 2 performance has been an improvement from a year ago, earning $171.69 million in revenue for the quarter just ended, compared to that same quarter in 2022, where they only earned $161.5 million. The company is still trading a little bit higher than its fair value, but I still believe it's a stock you should have in your portfolio. Sixth Street Capital paid out its regular dividend this month, which puts the total earned at $10 New Zealand and 81 cents. The stock has increased 5% over the past month and is now for 2023 increased in value by close to 12%. It has remained a strong buy according to analysts and is currently trading below its target price by $1 US, so you could still consider purchasing it at this moment in time at a slight bargain. The S&P 500 paid its second dividend of the year, which came in at $20 New Zealand and 88 cents. The total for the year now sits at $39 New Zealand and 20 cents. Since the start of the year, VO has managed to recover from the market's initial loss and has started to generate its average 8% per year return, coming in at a 19% return between January and July of this year. I know this is a boring holding to have, but it's one of my favorite holdings due to the reliability and safety of it to date. It's also a no-brainer that due to its past performance, if it's able to continue to replicate this in the future and hold on to its 8% 8% average return per year, then either a $500, $5,000 or $28,000 initial investment could turn into $1 million in either 33, 32 or 28 years, considering you continue to invest $100 each month. It's a great hedge to have against myself since this tracks the market, and as investors we all know that the market in most cases always wins. To close up, July was a bit of a disappointment as I was expecting to net over $200 New Zealand dollars in dividend income. But with the recent dividend cuts from the likes of FSK, Newt and IFN, it's understandable to see why. We have started to see some minor returns after our capital gains have shifted into the green, which represents a month-over-month change of 297.3%. Our simple return on the portfolio is now at 2.4%, and our total portfolio dividend yield is starting to trend a little bit higher than liked at 5.59%. August is usually one of the slower months for dividends, so I don't expect the large payment for this month, especially after a lot of major payers having decreased their dividend payments. To get to my yearly goal of $2,400 in dividend payments, I'll need to average roughly 208 New Zealand dollars per month for the next 5 months, which will be close, but it should be achievable seeing as we've managed to earn $1,067 in the last 2 quarters of 2022 with lesser portfolio size. As always, thanks for watching, and I'll provide you with an August update as soon as I can. Cheers.